Hi, thanks for joining me on my market report. My name is Mike, and my market report's on mortgage rates. We get into discussing what's driving mortgage rates on a given day, and sometimes it could come from the economic calendar, or headline news, or geopolitical. But sometimes also we could have a market sentiment change. So, whereas good news is now bad news, and vice versa. And that could be a little confusing for those people who are watching the markets and not understanding why the market's reacting the way it is. Um, so we try to give the explanations as to what's going on, what's in investors' minds, and what's uh, reason why mortgage rates are doing what they're doing. So, a little bit about myself is I'm a loan officer. I do work with a national lender. We do loans in all 50 states. So, if you guys would like to discuss refinance or purchase, we're here to help you guys out. But more than that, we're here as a resource. So, if you guys got questions about anything, we are here to answer and hopefully get you the information you're looking for. Without further ado, we'll start off with the economic calendar today. We got a lot of items on the calendar, so we'll start off. Well, it's not really. I don't consider this economic calendar idea, but the Bank of England gave their announcement today, like our Fed did yesterday. They also had a rate hike again today, so that came in as expected. The rest of the stuff that they had was pretty dovish, so the markets didn't really react to it. But the first item here really is more or less a economic data, and that is the housing starts for the month of February. So it went up by 6.8%. So we'll start off with a revision for the month of January. It went from 1.638 million upwards to 1.657. Forecast is coming for 1.69, and it exceeded that to 1.769 million seasonally adjusted units. Now, future housing starts, which is our building permits, um, also dropped in the month of February. As we've been seeing, the confidence level for home builders have been dropping. So, uh, not too surprised by this. So, but we still need obviously more inventory. So, as you can see here, January was at 1.895 million. It forecast was at 1.85, and it came down to 1.859. So a little bit better than our forecast. However, it did drop from January's numbers here. Now we also got the Philadelphia Fed index, which is manufacturing in the Philadelphia region. If you remember, we had the New York one come out this week, and that came as it contracted. So, however, in Philadelphia, it was the opposite. It went from 16 in the month of February. Forecast gone for 15, and then instead of dropping a little bit, it actually went upwards, almost doubling to 27.4. So we had a great month for the manufacturing in the Philadelphia region. Now, we also got jobless claims, which we get every Thursday. So last week's report was revised slightly higher from 227,000 to 229,000. Forecast is supposed to drop down to 220, and it dropped a little bit further, 214. So we got a pretty good number right there. And then as you can see here, we saw the continued claims drop from one week to the next. So we had a slight revision lower last week's report, and even from that number, it's still lower than what we had anticipated, even lower than the forecast. So good overall numbers right there. Last but not least, we got the industrial production for the month of February. So January it rose 1.4%. Forecast is supposed to rise a 0.5% in February, and it came in rate expected at 0.5%. So all good news here. Still, investors are watching the Ukraine and Russia affair. It's not having as much of an impact on the market today, as it's nothing new is being reported. They are still kind of looking at the Fed's announcement yesterday. However, they have kind of gone through that and felt comfortable with it. So it was a bit hawkish, but they did raise the hike it a quarter basis point. They do feel the economy is growing, but of course they need to kind of stave off inflation. So that will be the primary focus, which is obviously better for our economy to even if we go into a recession. It's better to go into recession than have stagflation. Um, but we also got they did mention the balance sheet, so the balance sheet will probably be start. They'll probably start discussing at the next meeting here. So prepare for some choppiness ahead for that because that is one of the things that was uh, kind of tough on the mortgage-backed securities, especially when they talked about when they were probably going to reduce their balance sheet and pretty much get rid of all the mortgage-backed securities and just hold treasuries, that's something that we'll have to kind of watch and see. That's not obviously that's not good news for mortgage-backed securities or mortgage rates. So otherwise, that's kind of where we're at. It's pretty much the data that kind of calendar. Stocks are up. Mortgage-backed securities, as you can see, are up. Yesterday was pretty much a seesaw type of a day. We were way down, like around 50, 60 basis points, and ended up closing down 39 basis points. So it wasn't as bad of a day as we initially thought it was going to be. Right after the announcement, it just started tanking, and then it kind of subsided after they had some time to review the numbers here. But today we're currently up about 19 base points. We got a slight wick on both sides here, so there is a little uncertainty in the market still of where we should be priced at. But we're also it's been taking such a beating that more investors did come in and start buying a little bit. So that's what's kind of helped us out a little bit today as well. Kind of buy on the dip, so to speak. So right now we're up 19 base points. Rate should be slightly better than where we left off yesterday. As you can see here, treasuries, we're at 2.16 now. We're off from the highs yesterday, which were touched right up at almost 2.5, 2.25 basically, at 2.46 here. So right now we're down a little bit to 2.16 at this moment. So lastly, we'll go over the average rate for the conforming loan limits, which is at 30 years now 4.48%, and the 15 years at 3.85%. These do have points built into them. Again, these are just averages. These aren't probably something to be quoted, but it gives you kind of a baseline to factor off of there, especially when there's points included with it. So everybody's is a little bit different because it can go from different loan programs to the type of property, to occupancy, to your FICO scores, how much equity or down payment you have. All these are factors in there. So anyways, hopefully that will answer any questions. If you guys got questions about it or if you guys want a rate quote, please reach out. We're here to help you out. Again, I'm a loan officer, so we can certainly do that for you folks. In the meantime, if you guys like these videos, please help us out. Smash that like button and share. We greatly appreciate it. We do appreciate you guys. And if you guys got questions, reach out. We're here. Thanks so much for watching. We'll see you guys in tomorrow's video. Have a great rest of your day. Bye-bye.